interesting because we did see some risk-off coming into the market in yesterday's session in the US. But I want to note what's been happening below the surface in terms of the rotation away from the tech, the stay-at-home stocks, and into some of the more cyclical value sectors and small caps as well. What do you make of what's going on below the surface in markets as opposed to the headline move in the S&P 500, which seemed to be shaken after 7 days of not being shaken by this impasse in stimulus talks?
Yes, so I think what we're seeing in markets just reiterates the idea that it's important to have a framework to look at the crisis, a framework to how to manage money as opposed to react necessarily to headlines. As you pointed out, the talks collapsed on Thursday, and it's only yesterday that we're seeing a reaction in markets. I think the trend, there's been some underlying trends in terms of the dollar, in terms of yields, and we're seeing a shift little by little away from these assets which benefit from a strong dollar, which benefit from negative real yields, into other type of stocks and of positions, perhaps a little bit more cyclicals.
Good to see you this morning. I just wonder, I'm looking at... Sorry, go ahead, Frederique. Finish your thought.
In terms of our own positioning, we think that the second half of the year is likely to be a little bit more choppy than the last few months. And so we think that it's a good idea to have a balanced approach in terms of sectors and have some defensive, some cyclical, some secular growers. So we like healthcare, which would be a secular grower. We like utilities, which is a defensive, and industrials, those particularly which are underpinned by secular trends, would be our pick for cyclical sector.
Frederique, there were a whole number of themes that came to play yesterday. One of them was the repricing of 30-year paper, 10-year paper in the curve. We saw the curve, steepen ever so slightly. Now, I want to get a sense from you. At the back of it, you had the PPI and you had supply. Is this the beginning, or is this a fresh reminder of what an asymmetric move might look like in the bond market?
So, the yields had reached a very low level, and I have to say that economic numbers over the last few days have been slightly more positive. We are seeing the second wave, which impacted the economy in the US, having less of an impact, and economic indicators improving there a little bit. We're seeing relatively good numbers in Europe, with PMIs and European Commission sentiment numbers suggesting that the better momentum over the last few months of the second quarter is being continued into the first month of the first quarter. Relatively good numbers from China. So this seems to be, in the short term, a slightly better tilt towards news flow. Clearly, in terms of how we get out of this recession, we think that after an initial bounce, it's going to take quite a while before we go back to pre-crisis level. We don't expect that in the US until mid-2022, and we don't expect to go back to full potential for the economy until probably 2024. So quite a long time to go back, less long than it took us after the great financial crisis. There was more than 9 years to go back, but certainly quite a long grind back up.